This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. What is up, Zinger Nation? Happy Hump Day, happy Wednesday. Thanks to everyone who is hanging out with us today. Thank you for being patient. I know we started the show a few minutes late today, dealing with some technical difficulties. Busy day today. We've got Jerome Powell at 2:30 p.m. Eastern. Of course, the FOMC announcement about interest rate hikes will come out at 2 p.m. That press release will hit, and then about 30 minutes later, Powell will take the podium. We'll talk about that. But I do have our first guest of the day hanging out backstage, and he's been patiently waiting, and I've kept him waiting for too long. So without further ado, let's give my man Francisco, our very special Zinger Nation, welcome. And when we come back, we'll be chatting with Francisco. Francisco, welcome to Benzinga Live. How are you doing today?
All good. Thanks for having me.
Of course. Sorry for keeping you waiting a little bit. I know you got to run soon, so we'll try to make this quick. Real quick, where are you joining us from?
London.
London. There you go. So it's what? It's about 6 p.m. for you right now? 5 p.m.?
5 p.m.
5 p.m. So let's get a quick brief introduction to you, to our audience. What do you do? Kind of how'd you get started in investing in markets, and what are you primarily focused in?
I'm mostly focused in the FX market. I work for an investment bank here in London as an FX strategist. So I work in the research part. So I look at the impact on currencies from anything that's happening in the world, basically.
Got it. So how long have you been, in kind of working in Forex?
Around 5 years now.
Okay. Well, I'm sure, actually, I shouldn't say I'm sure, but I'd assume that this past year has been the most exciting in terms of crazy moves in Forex. I mean, we've had a few different big kind of events in the Forex markets this year. Is that accurate, that this past year has been like the most maybe volatile?
Yeah, absolutely. It's been the most volatile, and it's been the most interesting because essentially we are seeing central banks move at a pace that we hadn't seen in a very, very long time. So it's every month with central bank meetings, it's things tend to change quite a lot, and data are having a huge impact as well. So it's very exciting times.
Yeah, and today is obviously a very timely day to be talking about the central banks again with the Fed announcement. The expectation is that the Federal Reserve here in the United States will increase rates by another 25 basis points. Francisco, I know some people, some economists, global economists, like kind of view the Federal Reserve as like the leading central bank, and then other, countries and banks will follow. Do you believe that? Do you think that's accurate?
Well, it's not anymore. The Federal Reserve is about to hit the peak. I think there's pretty clear. There's just plenty of evidence in the data that suggests that they are about to hit the peak. So they're going to hike by 25 basis points today. And what's going to happen is probably they're going to stick to that rhetoric of kind of hawkish one, suggesting more rate hikes will come. But in practice, it seems quite unlikely that they will need to hike by more than another 25 basis points. There's also
do you think this could be the last hike
today? No. We should get 125 basis point hike today and another one, and that will be it. But there's also a chance this could be the last. If inflation falls even more than expected, then and growth starts to look a bit grimmer, then why not? This could be the last one.
Yeah, and I think in terms of one thing that I talked about months ago is when the Fed first went from 75 down to 50. When the Fed did that, that was the sign that, because you can't say, okay, the Fed is as worried about inflation as they were, a month ago, and now they're going from 75 to 50. If they were as worried as they were about inflation, they would have kept it at 75 or gone up even higher to 100. Once they started cutting, that was my sign that, okay, the Fed's at least acknowledge, like you said, they're going to keep the hawkish tone, but they're at least acknowledging that inflation has moderated or cooled somewhat to the sense where it can start slowing down those rates. And I know it's not the same as a cut to say, okay, I'm going to raise by 25 instead of 50 or instead of 75, but it kind of feels that way, right?
Yeah, no, obviously, hiking by 25 basis points in the current environment is a very small rate hike. Sorry, maybe I said cut, but yeah, definitely hiking. So hiking by 25 basis points is a small hike with inflation running this high. So they are definitely acknowledging that they are basically taking this slowdown in inflation on board, and so this is already kind of a positive sign in a way for kind of risk assets here.
Got it. So, Francisco, I think it's interesting, about say like half a year, 6 months ago, over the summer, it seemed like basically all countries, developed in the developed world were like going through the same things together, right? Inflation was sky high. Everyone's dealing with the supply chain issues from the Russia-Ukraine war. Obviously, some European countries, maybe more so than the United States, but still high gas prices, high energy prices, all of these things. So like all the central banks, were hiking together, doing all these things together. Are we starting to see a little bit of more of a divergence now where we see like, certain countries are in a better position economically than others? So maybe now the central banks are starting to do things a little bit differently?
Yeah, absolutely. We're definitely starting to see that. I think the most obvious divergence there is between the ECB and the Fed. The Fed is about to hit the peak with 25 or 50 basis points more of tightening, and the ECB tomorrow will do 50, and they should do another 50 in March. So it tells you that the economic outlook, which in the Eurozone has definitely improved on the back of lower energy prices, is now allowing the ECB to hike more. But then we have other stories. In Canada, the Bank of Canada is done with hiking. There are the fragility of the housing markets in different parts of the world, which are becoming very relevant now, and it will determine how much central banks will be able to push rates higher. So it's a lot of local stories, much more than it was before, when the Fed was leading the way, and kind of most other central banks were trying to follow.
Yeah, and I mean, can I ask you a hard question, Francisco?
Sure.
Why is England? I mean, you're in London. Why is England in such a tough? I mean, is it all? I know people like to point to Brexit, but I mean, like, are there other explanations for why England is in a tougher economic situation right now than surrounding countries or say the United States?
Yeah, well, it's a combination of factors. It's been quite hard to isolate the Brexit effect in the UK economy, simply because this happened during the pandemic, when there was plenty of fiscal stimulus and ultra low rates. So at the moment, the reason why the UK is, aside from kind of Brexit related issues, is that kind of that unwinding of fiscal stimulus has been quite quick. The latest, there has been quite a lot of political instability on top of that. And basically the new government decided to kind of unwind a good deal of support for households to cope with high energy prices. So essentially, the government is accepting a kind of a larger impact. It's going to tolerate a larger impact on households and consumptions from high energy prices, from high bills, and that's the first reason. And then obviously the Bank of England started hiking pretty early, so that is starting to hit the economy now. The monetary policy tends to hit the economy with a certain lag. And this is not what we haven't seen it just yet, maybe in the Eurozone, but we are seeing it here in the UK for sure.
Got it. Yeah, and I mean, I know I saw like a take from a banker, an analyst the other day, that basically said that like we now expect most of Europe to like narrowly avoid a major recession in 2023, except for maybe England or something. And I was like, why is I was just trying to understand like why is England kind of being viewed in like, okay, like everything is starting to get better, but maybe not here. And I mean, I know there's been a lot of political, and I mean, okay, here while we're talking about England, let's talk about that move in the pound. When was this? That was back in the summer too, June, July, when the sterling just dropped on that. It was like over the weekend, right before a Monday, right?
Well, we had a lot of pound volatility related to kind of political developments, and that was very very big. You would not normally have for developed currencies such large moves on the back of what happens in politics, but essentially in the UK, the new prime minister after Boris Johnson resigned, essentially tried to deliver some very bold moves on the fiscal side, and that raised very serious concerns in the market of the sustainability from that perspective, and that basically sent bond yields through the roof, and markets started selling their sterling positions kind of across the board. So it was a very sharp correction. Eventually, a number of factors had to fill in to kind of put the situation back in place. The Bank of England had to intervene in the bond market to kind of follow their stability mandate, and at the same time, the government changed again, and the new government had to hold a much more kind of conservative and cautious kind of approach to fiscal policy, and that has eased those kind of debt-related concerns.
Got it. Yeah. So, I mean, going from here, Francisco, I mean, what do you think is going to be, what are going to be the big factors? I mean, if you want to stick to England, that's fine. Like, what are going to be the big factors in England for kind of coming out of this economic turmoil? Kind of like, what will be the light at the end of the tunnel, if you will?
Well, it's not easy to say. It does look like a structural kind of downturn, in the UK. I think that something on the fiscal side is probably what can determine a big difference. It does definitely look like the rules, that the self-imposed rules on spending have been a bit too restrictive by the new government. So I think we are in a situation where there is growing pressure for them to spend. We must also remember that basically the government at the moment, which is a Conservative Party-led government, they are widely expected to lose the next elections to the Labour Party. So there are some expectations that the Labour Party may stretch those fiscal rules and try to do a bit more spending. So that could be good news. But let's see whether the Conservative Party, going into the elections, would like to deliver a bit of fiscal stimulus as well, for electoral reasons.
Got it. And I think that's what a lot of, economies and countries are dealing with right now, is this idea of like needing to tackle inflation by any means necessary. And then eventually the flip side of that is eventually going to have to be, like you said, either cutting rates or doing some sort of stimulus to help this like struggling economy, because you can't have, you can't be crushing the demand to help the economy, to help inflation, and expect everything to run normally and people to be okay. Like eventually, you're going to need to flip that switch and turn the gas back on and say, okay, let's get the economy going again.
Yeah, obviously, I think we need to get to a point where inflation is no longer a big concern. We're not there yet. We've had some positive kind of developments in this sense, but if indeed with all the rate hikes and slowing demand and lower energy prices, inflation does get back to a normal level, then that is the point where fiscal stimulus can be deployed without the risk of generating another big inflation run. Because at the moment, deploying fiscal stimulus is too risky, because you can deploy fiscal stimulus if you have inflation that is running at 10%.
Yeah, and I think it's tough because people, I mean, like, none of us want to hear, like, when Jerome Powell says stuff like, we need to see that unemployment number come up, we're going to see pain in the labor market. Like, none of us want that. We don't want to see that, whether as investors or like just real everyday people. You don't want to get laid off because your country is trying to get inflation down from 4% year over year to 2%. It's like, I think a lot of it, but like you said, like, that's the first thing that the central banks right now are worried about and focused on is inflation. And then, once you get that under control, then you can worry about the unemployment,
Yeah.
whatever. I don't know. I mean, I get why it's controversial. I know there are a lot of economists that disagree. You have people who, kind of more people in like the MMT camp who think you can just keep, the gas on forever without seeing inflation rise up. So it's a whole controversial thing going out there right now with the central banks. But this has been a great discussion. I want to ask Francisco, is there anything that's been top of mind for you that we have not gotten to today? I know I got to let you go soon because it's so late your time.
Yeah. Well, yeah, there are a few things going on. I think the Bank of Japan remains a very interesting one to watch over the coming months because they're looking more and more likely to drop their yield curve control, and that will have ripple effect in the FX markets. And China is just a huge driver. We'll see how numbers will look like after the Chinese New Year holiday, and that will be very important from a growth perspective, and also how they've coped with their reopening of the economy with a big holiday. So this is really important. It's going to be a huge driver.
Wait, so the Japanese yen has actually been pretty strong against the dollar the past 6 months, or sorry, the past like 2 or 3 months or so. Is that so? What's been driving that?
Well, mostly the Bank of Japan that turned essentially hawkish all of a sudden.
Well, that's like the first time in 30 years, right? The Bank of Japan's been hawkish.
Yeah, exactly. I mean, this is the first time the Bank of Japan is doing anything at all, basically, in a very long time. So that was very surprising. And in the spring, we have a change of governor, and a lot of market participants are seeing this as the potential moment where they eventually drop their yield curve control or tweak it, or tweak any other side of their ultra dovish policy tools. They have a lot of things that they can change, and that will have some pretty important implications from asset allocation perspective, because bonds in Japan may become rather attractive again.
Yeah, and I mean, so sorry, what was the second thing you were talking about after the Japanese yen? You said there was one other thing that was kind of top of mind for you. I wanted to touch on that as well.
China,
that's right. So China, I mean, you go on and on about how important China is for the global economy, all this stuff. What do you think? I mean, we're seeing kind of a recovery now in terms of they're finally getting over the zero COVID policy. Like, do you think that currency, like, do you think their economy is going to remain strong, or we're going to see some more pain there in the next year or so?
Well, everything seems to be pointing that they're actually on the right path to recovery. There are still big uncertainties. The big uncertainties are, number one, how sustainable is the reopening with not too encouraging vaccination rates in China. So that is the first thing. The reopening will not look just like in Western economies that had very elevated vaccination rates. This is the first factor. And secondly, they still have to deal with slowing global demand. And that is going to happen because obviously the global economy is in a slowdown. We think that despite those two, there may be some positives arising from the fact that Beijing may want to ease some of the trade tensions and diplomatic relationships with a number of Western economies. And this would be really welcome and should probably give a boost to Chinese markets. So we think there are good chances that markets will kind of move back quite substantially into Chinese markets, and that also from an asset allocation perspective is pretty big.
Yeah, isn't that what's so funny about the financial markets and investing is, like, a year ago, right? Everyone hated the Chinese names, right? There's zero, there's zero COVID, the government's going after all the companies, whatever. And then as soon as like the tides turn and now some bullish news, everyone is so bullish China now, buying Baba, buying this, buying that. And it's like, oh my God, I thought you guys all hated Chinese names a year ago. So it's funny how that price, both the price and kind of the sentiment regarding the overall economy can change so quickly on a dime, it feels like.
Yeah, no, to be honest, it did feel like China started to change things much more rapidly than they used to. I mean, if you look at the zero COVID policy, they were holding it up until the point they have a few protests, and the week later, basically they started unwinding all those COVID policies, So everyone was expecting, okay, they're going to keep the zero COVID policy or very gradually unwinding it. And actually, in a matter of 2 weeks, it was basically gone. So,
yeah. And I remember when those protests
change this rapidly, then what you can make, also you can start to speculate on other things changing rapidly, like, the crackdown on tech and on real estate and on education. If the Chinese government becomes more proactive from this point of view, and they want to kind of revamp the appetite for Chinese assets, and the attractiveness of Chinese markets, then why not? They can definitely deploy a number of other measures to do that.
Yeah, and I mean it's interesting because like people see like when China, whatever, like you said, education announced that all right, it was cracking down on the education industry in China. There was going to be no more for-profit education companies in China, and people are like, oh my God, they're so anti-business. I don't want to invest there, all that stuff. And I was like, I understand, right? China's showing that they're willing to kind of crack down on businesses more so than the United States or maybe some other Western countries. But like, I don't see that as that bad of a thing, right? Saying that educational companies shouldn't be, run for profit. So it's like I have different, I guess like thoughts when I see stuff like that of thinking like, oh my God, this is like the most bearish sign ever versus being like, oh, it's actually like maybe a good policy to have. I don't know.
Yeah, well, definitely. I think, but there's been this big shift in about a year and a half from basically doing some anti-growth kind of measures.
Yeah, I think the stuff outside of the education,
Yeah.
when they came in and nixed the Ant Group and the Baba deal, stuff
they
like
really
that.
wanted to deliver a message that they were rebalancing. They wanted to have a go at the rich, at the big corporations, and kind of from a redistributive kind of kind of policies. But now, if you look at the latest things, it doesn't look like that much. It looks like they're looking much more at growth, because with COVID restrictions being so long, growth started to look so bad that they had to kind of switch back to a pro-growth stance. And that obviously you cannot have both at the same time, or at least you could, but it's harder. Yeah.
Right, and yeah, I mean, I think we are seeing, I mean, even specifically with that Ant Group example, there was a headline a week or so ago that now they're allowing, Jack Ma and others to like raise money to bring that public again or something. So it's like, okay, maybe they're starting to get a little bit more pro-business all of a sudden. But Francisco, I know I brought you on late and I've kept you for on longer than, so I want to make sure I get you on with your evening. Would love to have you on the show again. I mean, anytime we have any developments in like the Forex markets, or I need someone to come and explain to me what's going on in England or anything like that, love to have you back on the show.
Yeah, absolutely. Thanks a lot for having me.
Of course. And we'd also, I mean, if you, I don't know if you ever write anything, but if you guys ever want to publish, like an article about some findings in the Forex market, we're always looking for more Forex content, especially on the international kind of like European side, because we only have a few, U.S. Forex contributors here. So we're always looking for more content there.
Yeah, no, absolutely. Be happy to.
All right. Awesome. Well, enjoy the rest of your day. Thanks again for hopping on. Everyone out there in Zinger Nation, smash the like for Francisco. We'll chat soon. All right.
Thank you very much. Have a good day.
All right, guys. That was Francisco Pisol joining us from London, talking about the Forex markets, what's going on in Europe and everything. I mean, guys, this has been probably got to be one of the most interesting, market times from a global perspective. You have basically all the central banks forcing to deal with inflation and still, fallouts from COVID and now the Russia-Ukraine war. I honestly I don't think here's a great sign that people like have no clue what's going on right now. You had Jim Cramer yesterday saying like now's the time to buy. You had Michael Burry saying now's the time to sell. People don't know. Are we about to go back to breaking down lows? 3,500 on the SPY. We're looking at were the lows a couple months ago. You go on Twitter or Reddit or wherever you are. It's every other post. Like one is saying we're about to go back down to new lows, or we're about to break out and make new highs. I can't remember a time, at least since I've been following the markets the past, 3-4 years or so, that's been so. Actually, I will say no, because even then, like I'm thinking back to like May 2020, after the market had basically like rebounded fully from COVID. There were a bunch of people that were short there, saying like, why is the market back up to where we were? The economy's shut down, like all of this stuff, and got really short there. But there were other people, I think, still calling for SPY to move higher there. So that was another like kind of very polarizing time where people didn't know what was going on. Here's what I'll say, and this isn't investment advice. My prediction for today, for Jerome Powell, for the Federal Reserve, 25 basis points at 2 p.m. Boom. That's baked in. That's priced in. I'd put any amount of money on it. I don't see a scenario where they go 50. I don't see a scenario where they go 0. 25 is the number at 2 p.m. But then at 2:30 is going to be where the real, market move happens, and the real, kind of like meat of the day is going to come at the press conference at 2:30. And here's my prediction for that. I could be way off, but I don't think I'm going to be. I think I'm going to be exactly right. Jerome Powell is going to come out. I'm going to say, yeah, we did 25 basis points, whatever, yada, yada. If y'all remember, the last time Powell gave this speech, I can't remember if it was a month ago or 2 months ago at this point. He basically said, we still need, I forget the exact phrase he used. He basically said we need more significant evidence that inflation has fallen. Essentially saying, yeah, we've seen inflation falling, but it hasn't fallen enough. We haven't gotten to that point yet where we feel comfortable cutting rates. Now, a lot of people, if you back up a few months ago, whatever, a lot of people started betting, like the bond market started pricing in a chance that we would start cutting rates as soon as today, that this Federal Reserve meeting would be when we started cutting rates. But a lot of these people that thought so not because they thought that inflation would have already been down to the 2% target by now and that the Fed would be able to start cutting rates. They thought the Fed would start cutting rates right now because it would be forced to start cutting rates because the cracks in the economy would be forming, that unemployment would be rising. But that has not been the case. Throughout the past few months, as the Federal Reserve has been raising interest rates, we haven't seen an increase in unemployment. We haven't seen the economy really slow down. So the Fed really has no reason, based on that mandate, based on the unemployment mandate, to start cutting rates. And that was the expectation by a lot of investors was, yeah, the Fed's going to keep raising rates to deal with inflation until it has to start cutting rates, until it's forced to start cutting rates because people are, losing jobs or, all this stuff. But that hasn't happened. That hasn't been the case. So I see it as like a very ironic twist of fate, if you will, that the market is almost being punished because the economy is too strong. If the economy had been weaker, if unemployment had been going up, the Fed would be forced to start cutting interest rates. But that hasn't been the case. The Fed is able to keep rates higher because we haven't seen unemployment come up, because we haven't seen the economy really start to struggle. And that's where you heard, if you listen closely and you heard Jerome Powell say things like, we expect to see pain in the labor market, or we need to see that unemployment number come up. It's not because Powell's this evil man that wants to see people lose their jobs or whatnot. It's just the fact that that's the way it's always worked. It's the way that inflation has always come down through higher interest rates has always been associated with an increase in unemployment, with essentially a recession, which is why I, here on the show, like push back against that idea. It's like, why are we so bought into? Why are we saying with essentially 100% certainty that the only way to bring inflation down to a comfortable level is to essentially engineer a recession, to crush demand that will bring unemployment up? That's what Powell was saying. And I was saying, like, why are you saying that? What is your evidence that you have to show that there's no possible scenario, right? That Powell basically himself threw out a soft landing. Said, yeah, that's ideal. Like, ideally, we raise interest rates, bring inflation down, unemployment doesn't rise. And he basically threw that out the window. Said, no, we're going to need to see pain in the labor market. We're going to need to see unemployment come up. Because that's what's always happened in the past. But that sample size isn't that big, right? There's only been a few other times inflation has gotten that high in the U.S. and stuff. And those times, yes, the higher interest rates have been associated with the recession. But what we've seen the past few months has given me more and more confidence that some sort of a soft landing is possible. That it's possible to bring inflation down without a huge increase in unemployment. So maybe we'll hear Powell say, something regarding that today, talking about how, we actually have seen inflation start to moderate without an increase in unemployment. So maybe we can keep this trend going for longer. I think the market would respond really, really well to that. Essentially Powell sounding like he's now back open to the idea of a soft landing. Because again, in the past, it was always, no, we're basically going to need to see unemployment come up. We're basically going to need to see a mild recession to have inflation come down. And that hasn't been the case. Fed is out of touch. They only use backwards looking data. I mean, yeah, I think that's part of it, right? They're looking at inflation data that's trailing. So, Elon, I'll say this. I don't think it's good or bad at this point because the 25 is priced in. It's has any Fed ever done a soft landing? But that's my point, Jay. Is that how could you say because it's maybe never been done or maybe never been done on that scale that it's not on that scale that it's not possible? What is the sample size for times that we've been dealing with this high of inflation and also a potential, you're looking at what, a sample size of like 8? Because 8 times in the past when we've seen high inflation, we've had to engineer a recession to bring inflation, right? Like it's like, to me, that's not really that good of an explanation that the Fed has one tool and that's to raise interest rates, which can cause a recession. That will bring inflation down. So that's the only way to do it. That's the best way to do it. I mean, I made the point, which I guess doesn't really stand. I don't know. Okay, so I made the point back when the Fed was initially raising interest rates. At that time was when we were hitting, 40-year highs of inflation, whatever. Those first super high CPI prints, if you look at what was driving the high inflation, they're completely different things than what's driving the high inflation now. At the time, a lot of it was from used and new cars. There was the huge semiconductor shortage. And I made the point, this wasn't my original idea, or point, but I made the point on the show that there's an idea out there that raising interest rates, all that's going to do is slow down production in the chip space, actually could make inflation worse in that sense. Now, what ended up happening was the rising interest rates kind of crushed demand, not just for some cars, but also like, crypto, which helped the semiconductor. So that in itself was an ironic twist of fate that the rising interest rates actually did bring down the price of chips because it crushed demand in crypto and other areas, which helped there be more of a supply of chips. But the idea was, right, that we have a shortage. It's not a demand issue of chips. It's not that demand is increasing and supply is staying the same. It's that supply was constrained and demand stayed relative. So instead of increasing that supply, which would require essentially lower interest rates or more investments, we raised interest rates, which lowered the supply, but then also lowered the demand, which ended up working out. You would look to Turkey and Venezuela. Yeah, I mean, like, I don't know. I think if you study the economy, you realize, like, comparing Venezuelan inflation or the Venezuelan economy to the United States is vastly different. I mean, a lot of Venezuela's inflation problems came down to the fact that its economy is basically fully reliant on its oil exports. It's basically like a one economy ran by one thing. It's oil. And like a lot of other factors into like there's literally no comparison, I don't think, to looking at Venezuelan inflation to what's going on in the US markets today. And I think that's a very crass, unfair, I don't know. I hear that all the time. I don't really know what you mean there, Jay. Because from the way I understand it, right, inflation, not necessarily the weakening of a currency or anything, but just the price increasing. So I think in like an economic model where there's no government at all, like there's still can be inflation if supply is lowered and prices increase. I don't know. Maybe there's a different definition of inflation than that we're looking at, but I don't understand that comment either. But yeah, that was my point, was that like, I mean, I'm sure if like people are like still like a soft landing isn't possible, I bet those same people would have told you 6 months ago it wouldn't have been possible to bring inflation down without seeing an increase in unemployment or a mild recession. Like, it makes no sense. Like, it makes no sense how you could look at what's been going on the past few months and then your conclusion would be we need to see a recession to bring inflation down. How could you possibly believe that if the unemployment's actually been moving lower? Look at this. I mean, look at this. How could anyone possibly say that we need to see a recession or need to see the unemployment number increase when, all right, look, October 2022, what was that, 3 months ago? October 2022, the unemployment rate in the United States was 3.7% 3 months ago. Now, it's December 2022, 2 months later, it was 3.5%. So we added jobs in that 2 month span, meaning the economy grew, right? The GDP number beat expectations too. Let's take all these things that are factual. The unemployment number went down over 2 months. Inflation went down over 2 months. And yet you still have economists that I don't know like how they can call themselves that or what they do or what they think they know, but sit here and say that the only way to bring inflation down is to see an increase in unemployment. How could that possibly be true? How could that possibly be true? How could it possibly be true that a soft landing isn't possible if we've been currently seeing unemployment and inflation both simultaneously move lower together? It's an illogical argument to make, to say that, the only way, sure, that's how it's happened in the past. Just because it's how it's happened in the past doesn't mean that's the only way, to deal with the current economic situation. So I think that's been one of Powell's and the Fed's problem, is they've looked at how the Fed has done things in the past. They've looked at history of central banks and seen how they've done it. Look at what's happening right now. And that's what I think the person in the chat who brought up the fact that like the Fed's looking at old data anyway. The Fed should be looking at so I do think that's a possibility for today, that Jerome Powell acknowledges this and says, hey, we've actually seen unemployment, the economy moving well and inflation moving well at the same time. If he says that, then it could be off to the races, because I think that would put people at ease of saying, okay, maybe they aren't, going to try to, really raise rates until we hit this recession or see this increase in unemployment. I don't know why you would. I don't know why you would be willing to, intentionally raise rates to a point where people are getting laid off. People are getting put out of work because you're trying to move, while inflation's already moving down, because you're trying to get to that target. If we're already on trend, if inflation's already moderating and on trend to continue to move lower and hit that 2%, would it be fair for Jerome Powell and the Fed to raise rates to a point where people are getting laid off so we might get to that point quicker than we would have gotten to anyway? Or would it be more fair to wait a few more months or however long it would take to get down to that 2% and then not have that increase in unemployment? I know which I would prefer. Jay Rice, when you pay people and hand them benefits, not work, it skews the unemployment index. So let me understand this. Jay, are you trying to say right now that the economy hasn't been strong over the past 3 months? Or that that this is a lie and that the unemployment number is actually higher? Because if we want to start saying, okay, these numbers are fake and the CPI is fake and the unemployment's fake, I'm right, really those numbers are wrong, fine. But I'm not going to get in that argument. I'm not going to do that. what are we going to be working off of then? If we can't agree on numbers, if we can't agree on statistics. Who was it? Ben Shapiro said facts don't care about your feelings. My boomer friend is buying up XLE dying today. All right, I see a couple of people talking about XLE, so we'll get to that. But sure, if you think the unemployment also, Jay, have we not rolled back our COVID unemployment benefits? Have we not taken some of those away? I think you need to look at that first too, because like that makes your argument even worse. If we've taken some of those things away and the unemployment number is still going lower. Conspiracy theorists. Yeah, Jay, I agree, right? You see the unemployment, you see, the jobs numbers, they give adjustments. The jobs numbers are never exactly correct. But that doesn't change my point. My point has just been that the economy has been strong. I'm not saying, oh my God, the strongest it's ever been. The strongest, it's not as strong as it was in 2019 before COVID. No, I'm not saying that. But if you can't look at the landscape of the economy over the past 3 months or so and say that the economy hasn't been like stronger than expected, at least. If you don't want to say strong, because that's subjective, stronger than expected, right? Like, how could you possibly pay attention to what's going on in the economy, going on in the markets, and not see that the economy's been stronger than expected the past? Jobs numbers have been beating, like the non-farm payrolls have been beating every single time. The manufacturing index beat, the GDP beat. How could you possibly look at all this and say, no, I really think the unemployment number is higher than I really do think unemployment's going up right now, even though all the numbers say otherwise. Get out of here with that. Exactly. Economy is strong because we're all out here hustling to afford eggs. Yeah, here's the other thing is, I know there are big tech companies doing layoffs and stuff, and we've talked about this on the show, that just because, Meta and Netflix are laying people off doesn't really mean shit for the overall economy, right? I'll even prove this, like, to if you guys want me to live stream later today. Walk down where I live here in Michigan, every single freaking restaurant, shop, etc. has a now hiring sign outside. I'm sorry, I wasn't, I was around in 08, 09. I can't imagine every single business at that time had a now hiring sign, right? Like, I can't imagine that everyone was trying to hire, like if all these companies and businesses are really that worried about a recession coming, like, why? Yeah, I hear you, DG. Like I said, I think just because the tech companies don't announce layoffs, or I think just because the tech companies announce layoffs isn't indicative of the overall economy. I don't think that's fair to say that those that don't even bother looking for jobs anymore. Well, I get it. A lot of these big tech people are probably a little bit overpaid, but just because someone was making like $250K a year at Google doesn't mean they're not going to be looking for work. I would venture to say a majority of those thousands of people who have gotten laid off in big tech over the past few months have, if not already found new jobs, have been looking, right? Like, I'm sure there are a few that are like, well, hell, I've got a lot of money. I can now take a few years off and go travel, or maybe, start my own thing. But I would bet you a lot of money that a majority of the thousands of people, because think about it, probably the most of these thousands of people that got laid off from the big tech companies are like, are more like entry level. You're probably a lot of like, people that have been working at the company for a year or two. And then by the way, Jay, to your point, I've long said on the show that like I'm not really scared in a sense that like you know, if Netflix and Meta and Coinbase start laying people off, that doesn't really spook me. I'll get spooked when, you know, Walmart and FedEx and stuff start laying people off. So I haven't looked into the FedEx news today. But see, like, yeah, shit like that would get me more concerned. Oh, see, yeah, cut global management. It should have been done 10 years ago. See, if FedEx starts cutting drivers, if Walmart starts cutting, you know, cashiers, call me. Walmart wants to cut 20% of its management team, sure, go ahead. I mean, again, that should have been done 10 years ago. FedEx wants to cut their managers, sure, by all means. If FedEx needs to start cutting drivers because all of a sudden they're not shipping as much stuff as they were a couple months ago, that's when I want to know. That's when I want to start shorting the market, you know, right? Once Walmart starts cutting cashiers because there's not as much foot traffic in its stores and it doesn't need as much cashiers anymore, that's when I'll start getting worried about the unemployment. But for right now, I mean, it doesn't matter if I look at data, if I hear things anecdotally from my friends who have left jobs and found new jobs less than 48 hours later, right? Like all these things that I'm seeing and hearing are not conducive to this argument that there's going to be a huge recession in 2023. And I'm not saying like I think the economy is, you know, in the best position ever, or that we're going to like make new all-time highs or whatever. I just think it's ridiculous that there are people out there that are saying that essentially the Fed needs to engineer this recession, or that there needs to be pain in the labor market. When if you're saying that, you're admitting that you have not paid attention at all to what's been going on the past few months, because the exact opposite of that has been going on. It's as if I were like, you know, like saying that that it's just like this thing's not possible. Literally while it's happening. If I were like, yeah, it's not possible that Mahomes is going to play on his ankle and make it to the Super Bowl. Literally while it happened. It's not possible to see inflation come down without an increase in unemployment. That was the argument that a lot of economists were making, you know, 6 months ago or whatever. In order to bring inflation down, we are going to need to see this increase in unemployment. We're going to need to see at least a mild recession. Meanwhile, inflation's been coming down. And arguing about the exact unemployment rate number aside, my point has been that this recession that a lot of people were worried about hasn't come. And I'm not trying to like take a victory lap or whatever, or say I told you so. But I don't know, like, who all is here in the chat that's been watching the show, but like, was I not talking about when everyone was saying about how the energy prices in Europe were gonna, you know, everyone in Europe was gonna freeze because they don't have enough energy and England is so screwed for the winter? Was I not sitting up here saying, I don't think that's gonna happen? Was I not sitting up here saying the bear case has been changing basically every month? 1 month it was because China was so locked down because of COVID. The next month it was because inflation in the U.S. was out of control. The next month it was because of the Russia and Ukraine war. The next month it was because about the energy situation in Europe. And then it's about this, and then it's about that. And it's like, you got to stick to one thing. If you're super bearish, tell me why. Can't be a different thing every month. That just makes me lose. You're going to lose credibility there with that. Yeah, again, I mean, I kind of see that the same way I see the big tech layoffs. I don't see companies laying off overpaid directors and executives that get $200,000 to sit in an office and delegate tasks or oversee things. I don't see that as like a bad thing, or B, a bad sign for the overall economy. I mean, look, it's a higher interest rate environment. What's that going to do? It's going to make companies more focused on their bottom line. Say, okay, what can we do to save costs here? It's a little bit tougher. That's fair, Jay. I agree with that. I mean, like, I could see the SPY coming down another 5-10% from here before we, you know, not 10%, that'd be the what, $40, bring us down to 360. I can see SPY come down another 5, but we've had a big run, right? Let's pull up the SPY chart. Let's look at this. Let's look at this. You know, I mean, this isn't like you look at the year, you look at the 5-year chart, this run right here from October to now, 13% ain't nothing. That ain't nothing. But my point is, like, when you factor everything in, the prices, whatever, this run makes sense. Because in the past 3 months, we've proven that the biggest problem, this whole downturn, right? From December 2021, from November 2021 and now, SPY down 25%. I know there are a lot of factors in here, but was not the biggest factor in that downturn inflation and the fact that the Fed was going to have to raise interest rates for a long time to tackle that inflation, right? Can we not say that that was the primary factor in this huge downturn? And so in the past 3 months or so, where the economy has kind of proven that, hey, we're starting to make progress on inflation, and hey, cherry on top, we're starting to make progress in inflation without seeing a big increase in unemployment, without seeing a come down in the economy. That would have impressed a lot of people 6 months ago. And I'm sure if you would have asked traders, investors, economists, you know, back at this time when SPY was at 350 in October, if I asked them, hey, if I told you that CPI was going to fall fall 3 months in a row without an increase in unemployment, without a downturn in the economy, they say, oh my God, the market would be ripping. The market, oh my God, the market would love that. And then now that we're seeing that, people are like, no, we should be bearish and cautious, which again, I understand. I wouldn't be shocked in the slightest if the market came down a few percentage points from here. Wouldn't be shocked if it came today, because I think Powell will remain hawkish. I'm not really bullish short term on it. Like, I'm not saying I think the SPY is going to go up the rest of this week. I just think the economy, we're in a pretty damn good position compared to around the world. If you look at relatively, and I think for whatever reason, there are a lot of people out there that, Michael Burry included, just is so bought into this idea of a recession in 2023. And I know there are a lot of indicators and factors that lead people to believe that, so it's not just like a gut feeling. But I guess I've just been annoyed that, like, some of these people who, what they're saying have been proven wrong, have still not changed what they're saying. And then in fact, like, to me, it's, I don't know. I honestly don't know why it's so annoying to me, why I'm so perturbed by these people that are, basically perma-bear. I think it's because they make shit up, or if not make shit up, like, I think it's because they, like their arguments aren't always, like, honest, it feels like to me. And the same thing with people who are perma-bulls. I'm not saying that. So I think, like, apologies for essentially that rant against these perma-bulls, perma-bears, sorry, that don't seem to, like, be willing to open their eyes and admit that they're seeing something that they didn't think was possible. Because that's fine to admit. That's fine to say, like, hey, I didn't think we'd be able to see inflation come down without a downturn in the economy, but we have. And that's significant. I haven't seen that take from literally anyone. I haven't seen one person say that. I've seen a lot of people, basically double down on their takes and say, okay, just wait. The rise in unemployment's coming. So again, Jay, I wasn't trying to, like, pick on you or pull your comments up. I understand you're not a perma bull. And in fact, like, you were agreeing with a lot of things I was saying a couple weeks ago or whatever. Eric Javenti says, nah, son, you don't understand. The Fed has to keep forcing things until there is a resolution. I don't know what res. All right, Eric, I don't disagree with any of this, any of your two comments. So I'll be clear. I'll try to be clear in what I think is going to happen today. So at the end of the day, the year over year core inflation is still, I don't know what it is, 5%, 4.8%, whatever it is, more than double the Fed's 2% target rate. I expect Jerome Powell to come out today and remain his hawkish tone. But because of exactly what I'm talking about, because the economy's been so strong, he's going to come out and say, we're going to keep raising rates basically because we can. Basically because we haven't seen an increase in unemployment. Basically, we haven't seen a downturn in the economy, and we're still dealing with inflation. So we have no reason not to keep raising rates. I know it's almost like worse for the market that the economy is so strong, because had we seen a big increase in unemployment, had we seen the economy start to slow down and everything, it wouldn't matter what the unemployment rate was or what the inflation rate was at. The inflation rate could be going back up, and the Fed would maybe still need to cut rates because it's dealing with the rise in unemployment. But because the Fed has literally no reason to on the labor market side, on the unemployment side, they're going to keep raising rates because the inflation target's still not there. It has a dual mandate. Right now, the inflation part of the mandate is its big issue because that's the one that's an issue. The unemployment one's not an issue right now. So, of course, the Fed's going to stay hawkish and keep raising rates. And when it does that, maybe then the rates will be at a point where we start to see, unemployment start to tick up. So if I wasn't clear, I'm not trying to say I think like the Powell's going to come out and be dovish because inflation's come down. I said I think that's a possibility, that I think he comes out today and acknowledges the fact that I wouldn't be completely shocked if he kind of, alluded to the fact that like, hey, shit, we've been surprised that inflation's coming down without an increase in unemployment. We're going to try to keep this going. We've got a good thing going right now. We're going to try to keep it going. I wouldn't be shocked if he said something like that. What I think is more likely, what I think is going to happen, is he's going to sound more hawkish. He's going to say, yeah, look, inflation's come down a little bit, but it sure ain't to 2%. Sure ain't to where we want it. We still got a ways to go. You were talking about Powell, whereas before. Yeah, I think I think that honestly is not just Powell, but like I do think the Federal Reserve, like the actual like people, like kind of being like out of touch. I forget what it was. There was I think it was like the chair, the Fed president from San Francisco or something, like said something in an interview like, I'm still paying like this much or whatever, and it's like if all the Fed people, like presidents and shit, are like living in like New York and San Francisco or whatever, and they're basing their like policies based off like what they're paying, that's probably not fair to like what's going on the rest of the in the country and stuff. So yeah, I would agree with, are you talking about like how the earnings have been pretty strong this year? I mean, or this cycle? Yeah, I agree that I don't think like, and that's the thing, is like, it's like people like share these stats like, oh, 70% of companies have beat. It's like, have beat what? They beat their expectations. Those expectations may have been lowered this quarter. Like, it's like, it does not necessarily, mean Powell's worth over 100 million. I don't think that's true. I don't think that's true. Yeah, maybe. I mean, if in 2019 his net worth was estimated to be in a range of 20 million to 55 million, and he's made some. I didn't know. I had no clue he had that much money. That's actually ridiculous. I don't know. I don't know what to say about that. I don't even know. Like, did he work in? Oh, I mean, yeah. I mean, he worked in law and investment banking before he went to a think tank, and then before he went to the Fed. So he's not like some guy who's worked in politics his whole life and has made $50 million. He worked in finance. I mean, I don't know. Like, I still don't. He's out of touch, obviously. But yeah, that did it did kind of there. I forget exactly who it was or what the interview was, but there was like one point specifically where I was like, oh my God, don't tell me that all of a sudden these like Fed people are going to start basing like what they're paying at grocery stores and stuff in San Francisco on our policies. Like, that'd be ridiculous. I did want to get to pull up Benzinga Pro real quick because I wanted to just talk about, I saw some people talking about XLE in the chat. So this was something I talked about on the show a few weeks ago, but essentially looking at the energy markets, like here, so XLE, basically for those maybe newer in investing or whatever, XLE is the Spider Select Sector Fund for energy. So it's not exactly like the oil and gas a chart of the oil and gas industry, but I kind of see it as like a parameter for the I guess let's see. Let's go to ETFDB and see. ETFDB is a good website, ETF database for looking up like what holdings are in an ETF and whatnot. So I'm curious. We're just gonna go here, go to XLE, Spider Fund. I just want to see what their top holdings are. There's probably honestly like an, oh my god, what I do. So yeah, I mean, you get literally like more than 43% or more than 42% of the ETF is Exxon and Chevron. So I see it as basically a parameter for the oil and gas industry. And here's what I think is interesting about a few things with the XLE chart. So a few months ago, June here. So first of all, you had your initial run ups. Okay, so February 2022, basically a year ago today, not a year ago today, but about a year ago is when the Russia-Ukraine conflict started. So energy starts to get, the supply starts to get constrained, bringing the price of energy higher. Actually good for these energy companies, right? I mean, we now don't have as much Russian natty gas. We're more reliant on U.S., whatever. It's good for Chevron, good for Exxon. Makes sense, right? Makes sense why XLE comes up so much. Now we're at June 2022. We're at, $93. This big move down, and it coincides with a big move down in the SPY and everything. This is where investors are now starting to get really worried about a recession in 2023. Whether you want to say that's like a mild recession or a severe recession. And in this time, you had some bad news in China too. I think China was like going back into lockdowns with COVID. So you had all these things happening. This recovery from here, to me, I've seen, I know it's not this simple. People have pointed out to me on the show before. I would expect if we're going to see a recession in 2023, if we're going to see a big overall downturn in the economy, I expect to see the XLE come down significantly. I'm talking about move from up here to $86 to below, 70. I'm talking about filling this whole gap to the downside. And you can say, oh, Aaron, I mean, even if demand falls for energy, things are still going to be constrained on the supply side, so it might keep prices elevated. Sure. But I don't care. I don't think the market cares either. I think if we're facing a global recession, the demand for energy is going to get crushed to an extent to which this will fall significantly. With all this said, there's a divergence here. There's a divergence. There's some sort of trade to be had. If I knew exactly which one it was to be had, I'd be a billionaire. I wouldn't be sitting here. So the XLE again. So here are the different scenarios. The different scenarios are that people that are convinced we're going to see a recession in 2023 are right. XLE comes down. We should be buying XLE puts. Maybe. The other flip side to that is that the XLE chart and the energy market as a whole is giving us an insight right now to maybe the fact that the economy isn't as bad as some people think or expect. I think the S&P 500 is still trading at a price right now that it has some sort of economic downturn priced in, again, somewhat, right? Like I think if you told Mr. Market right now, all right, 0 chance of a recession in 2023, SPY would be a lot higher right now. So I think there's still somewhat of a recession being priced in here. So basically what I'm trying to say is that I either think XLE is going to remain high and that the S&P 500 will catch up to it. If that's the scenario, then I want to be long S&P. Or B, the underlying economy is really not that strong. We're going to see a recession and I want to buy puts on XLE. I truly, truly believe one of these two things is true and has to be true. That we're going to see this divergence start to, because like basically, the way I'm seeing it, we've had XLE going up and SPY going down. And we're basically going to see that divergence fix. But, and I think it would make sense to do so. XLE is very cyclical and all the top holdings are at their highs. Look, I know, and trust me, like I'm very I don't love the oil and gas industry long term. When I'm building my portfolio of stocks I want to hold for a very long time, as a 25-year-old, I'm not throwing in, Exxon and Chevron. I don't even know those companies will be around in 20 years. But Urban Farms Project. So, all that's to say is that I'm someone who is like very willing to get in on some shorts on the oil and gas industry. I think the Chevrons and the Exxons of the world are as grotesque and evil as any corporations there are out there. Would love to get behind some shorts on those. However, and Easy Mike's pointing this out too. Here's what I will say. XLE is very cyclical and all the top holdings are at their highs. Yes, and we just saw Exxon, or was it Chevron, announce like the record-breaking quarter. And it makes sense because you go fill up your gas, even though gas prices have come down a lot, still super high, right? I'm still paying $3.50 or $3.75 a gallon here in Michigan. What happens if the economy stays as strong as it's been the past 3 months, right? Do we think those gas prices come down? No, I don't think so. In fact, I think they could even start to come up again because let's look at our gas prices and kind of what we've been dealing with and what we've been working with and what's been going on, because this has been, of course, one of the biggest things. So today's national average, $3.05 or $3.50. A year ago, $3.37. So we're higher than we were a year ago. A month ago, we were at $3.20. And, like all these, none of these things that we're talking about today are in a vacuum, or they're all related to each other. So when we started to see gas prices move lower, part of that was because there's this expectation, there's a slowing demand, right? That people were, whatever. So as that starts to subside, as those fears of a recession start to subside, people are buying more gas. There's more demand. Gas prices are starting to come back up. And I don't know, I'm not following what's going on in Russia and Ukraine on a daily basis, but I'd assume that the factors over there that have led to the supply being constrained are going to continue. I don't think these supply issues are getting solved overnight. So I would not necessarily want to be short these names right now in the chance that, say, the 3 months remains strong in the economy or gets stronger and supply remains constrained. Again, I'm saying this as someone who, would love to be short Chevron and Exxon and will look to get so at one point. I just don't know if right now is the time, because I'd be scared that this trend, what we're seeing right now, is going to continue, right? That a month ago, gas was $3.20. Now it's $3.50. And then it could continue going higher. Because if gas prices do continue to move higher, they'll be moving higher for a completely different reason in 2023 than they were moving higher for in 2022. Still related. Of course, the Russia shit still matters for the gas prices today, but the factors that are driving the prices are just different. Oh, wow. Shout out Eric. Have I ever considered that Powell or any of the Fed chairs are in bed with Wall Street? The cycles don't make sense. I mean, I don't even know if it's fair to say the Fed's in bed with Wall Street, because I think that's clear. I think the Fed is I will say, I honestly do think that the Federal Reserve sometimes cares more about what's going on in stock prices and stuff than they do about what impact the Fed policy is going to have on everyday Americans. But I don't think right now is a great argument for this, because the Wall Street themselves wants lower rates. I think all the big banks right? There might be a couple, hedge funds and whatever that have shorts out there that want Powell to remain hawkish. But I would guess that the majority of, whether you're looking at Goldman Sachs, Morgan Stanley, JP Morgan, whatever the biggest institutions on Wall Street are, probably all want Powell to start cutting right now. He's kind of going against them. If anything, I do think the political aspect of the Fed is more interesting because it's, Powell's a Trump appointed Federal Reserve person, and then he makes a decision, and then Biden gets essentially crucified for what's going on in the economy, even though it's really Powell. And then when Trump was in office, you had Trump basically pressuring Powell to keep rates lower. Which, by the way, if I were president, I'm not saying that to ream on Trump. I'm saying it's more of I'm saying this is more of a criticism of Powell, that I think he let Trump influence him, rather than saying than me criticizing Trump for trying to influence, trying to influence Powell, because I would have been doing the same thing. If I'm president, I'm saying, no, keep rates at zero, please, for as long as you can, because that makes stocks go up and that makes people happy. That's what Trump was doing. When the markets were at all-time highs in 2019 and before COVID, the Fed started talking about raising interest rates because they said, okay, we've been really low for a long time. Asset prices are getting to all-time highs. We're starting to maybe get worried about inflation. We want to start raising rates. And Trump was like, you better not. You better not, J. Powell. So I think the political, kind of influence of the Fed is more interesting to look at, because I see it kind of similarly to the Supreme Court. That, in theory, the Supreme Court's supposed to be an apolitical position, right? That's why a judge is supposed to serve a lifetime on there, because one president, because once a judge is appointed, then it doesn't have to show affinity toward. But come on. That's not how shit works in reality. It's not how shit works in reality, right? If Trump appoints Kavanaugh and Trump wants this and Kavanaugh, it's like he's going to vote with Trump. You're going to vote with the guy who appointed you. You're not going to whatever. So Powell, I don't know. And I will say, in talking about this, I don't think, if you still think the Wall Street's one, I don't think Powell, personally, is really making decisions based on politics or based on the fact that he's a Trump appointee or any of this. I will say, I think there probably are a lot of Republicans that don't hate the fact that the economy is inflation has struggled under Biden and looked worse, and it's an easy thing to blame Biden. I mean, think about the gas prices thing, right? How many times did I fill up a gas at a gas pump and see a little sticker that someone put on there that said Biden did this? And it's all right, I get it, he's in office right now, but what did Biden have to do with the Russia-Ukraine war that constrains supply and all this? Actually, Biden may have had some hands in the Ukraine-Russia war. Yeah, I mean, I think, I don't know. I mean, I don't want to get political. I'm not really, personally, I don't like Trump or Biden. And 100% the economy was stronger under Trump, but if you're going to say all these things were 100% because of Trump, and then all the, prices increasing are because of Biden, what? We're going to blame Biden right now for egg prices because 50 million birds have died of a flu? That's what we're going to do? I'm all down to have legitimate criticisms of leaders and politicians where they're necessary and where they need to be fit. But I mean, okay, and also, first of all, Jay Rice, the freaking only reason gas ever went under $2 under Trump was because of a global pandemic. So we're going to give Trump credit for getting gas under $2 because of COVID, but then blame Biden on egg prices when a bunch of chickens die? Like, you see how, like, kind of screwy this is? How politics can, like, screw with people's brains and be like, you know, thanks Biden about the gas prices, and then yet still be mad at Biden when gas prices drop at the fastest rate that they ever have in the United States. It's like, I don't know. That's why I don't like to get into that stuff, is because if you want to praise Trump because gas prices got under $2 because there was a global pandemic that crushed demand for oil, sure, be my guest. But that doesn't make sense to me, really. I don't think that makes sense to most people. Dude. He made us energy independent. I didn't realize we stopped importing any energy under Trump. Didn't realize that. I must have missed that. When did they go under $2? When COVID hit. And again, I'm not trying to single you out, Jay, but that's, again, like, that's indicative of, like, shit that I see all the freaking time, where people who maybe don't, and again, I'm not saying you, Jay, but I'm saying maybe someone who doesn't understand some of these economic factors and things that go into price. You know, the perfect example of this politics is these fucking documents thing. Like I said, I don't like Trump or Biden, so I thought it was fucking hilarious that both of them got caught with classified documents. But you had people who love Biden acting like a few months ago it was the biggest deal in the world when Trump got caught with classified documents, saying it wasn't it was the biggest deal in the world, now saying it's not a big deal, and vice versa. You had people 3 months ago saying it wasn't a big deal, now saying it is a huge deal. That shows you how insincere a lot of these arguments are. And so, what's Powell going to do? F the politics. All right. Thank you, TJ McCulty. You should be my new producer. Way to keep me on track. Difference is the type of, yeah, I mean, they're probably, you're right. I probably shouldn't be making a false equivalency there. And honestly, I haven't looked into it enough to think if I think one is more severe than the other. Like I said, I just think it's funny because I don't necessarily like either of them. And by the way, I don't think anyone should like any of our presidents or leaders. Like, we should all be critical and say, like, what can you do better? Not, I'm a fan of you, like it's a fucking sports team. But anyway, like TJ McNulty said, let's put the politics aside for a second. TJ, I need a new producer. If I need a new producer, you're gonna come over here because you keep me on track. Here's what's gonna happen today. It's a prediction. I don't know. I don't have a crystal ball. This is not investment advice. 25 basis points at 2 p.m. The market will move up slightly on that. I'll say the SPY is going to go up about 0.5% or 1% on that. Then Powell's going to come out at 2:30, and we're going to see the market move lower. The market is going to move lower because Jerome Powell is going to say, yeah, we've seen inflation come down, but it's still about double our 2% rate and above our 2% target rate. And on top of that, unemployment, labor market, economy has been strong. So we have no reason to think that we need to start cutting rates. So I'm sorry, I'm just catching up on the chat. Hold on. All right, I need to fact check some things in the chat. All right. So okay. To people, by the way, I know it's all egg prices. 1 hour to go till that. Yes. My SQQ calls in trouble. Well, yeah, but like I said, I expect the market to move lower at 2:30 when Powell takes the stand. So you might have to endure some pain if the market moves higher at 2 p.m. But I could be completely wrong, and the market could move down at 2 p.m. I don't know. So okay, here's the thing. So Who was it? Again, TJ McNulty. I know we're not. We're gonna stick to Powell, and we're gonna stick to Powell and to what's going on with the Fed today. But I just want to address these comments real quick. So I understand that gas was lower before COVID hit in 2019 or 2018, than it is today. Mo is saying pandemic hit 2019. Check the dates. Jay Rice saying wrong. That Trump did more drilling, which helped bring the supply higher. So okay, Mo and Jay, would you guys agree then that it was good, essentially good leadership under Trump that he increased oil drilling? Which, by the way, I don't even know if that's true. Is that fair? To what you guys are saying, right? That was a good thing that he did, that Trump did, was increase drilling. Is that correct? Is that fair to say? Whatever the market does, a knee-jerk reaction. I trust you, TJ. I wouldn't do that. I mean, I'm not even. I don't even do that. I don't even trust myself with that. So okay, I'm not going to wait for them to reply, but let's assume yes, that they said that that was a good thing, right? That Trump increased drilling. So okay, if that's so, that was the argument, right, being brought up in the chat. And again, I don't care about this like political. I just want to make sure that like people know factual, because that's something I do care about. Is like that if someone's gonna say something in an argument as a fact, that it's actually factually true, and not just made up or whatever. So Mo says that Trump got gas prices lower due to the surplus created with additional drilling. Mo, I don't know if you're still here, but I got some news for you, man. Again, I mean, this might be one of the this might be a fake, more fake numbers, fake news, whatever, but analysis from the oil and gas industry showing that Biden is approving more oil and gas drilling permits. By the way, I don't like Biden. Like I said, I don't even think this is a good thing. I don't think we should be doing this. But if that's your argument, that was a good thing when Trump was doing it, and Biden doing it, like, it just makes no sense. So that's why I think when we're talking about economy and stuff, like, let's just try to keep that. Okay. Jay Rice says that's a Washington Post, so he doesn't like Washington Post. Should we find how's is Yahoo News permissible? Like, what who needs to say it, Jay? Fox? OAN? Like who needs to data from the Bureau of Land Management shows that President Biden approved more oil and gas drilling permits in his first 2 years of office than former President Donald Trump. From January 2021 to January 20, the BLM, that's a funny acronym, 6,400 permits for oil or gas drilling on federal land compared to 6,100, so about 300 more under Biden in the first 2 years. Despite that statistic, Republicans have routinely criticized Biden over his aversion to selling new oil. So again, that was just my point in bringing this up, was that people will take literally the same exact thing, say it's a good thing when one leader does it, and say it's a bad thing when one leader does it. So why even bring it up at all? Like, why even talk about it all? We're talking about the economy. We're talking about money here. I think that's true, honestly. But I think the flip side's to it true, too. There are people on the left that you can't reason with either, which is why I like to just look at facts and stay independent. Say I don't like either of them, because I can look at those things and say, yeah, I don't think us drilling on federal land is good at all. Well, there's benefits to it. I should say that, the price of oil and stuff. But I would probably do things a little bit differently. Yeah, I mean, okay, so this is the other thing that I think people don't really understand. About, you know, just energy in general. It's very, people, we want to make it out to be all about the government and leaders and stuff. But look, we're talking about the stock market here. We're talking about money. At the end of the day, what did Wu-Tang say? Cash rules everything around me. It's about the money. Follow the money, stupid. So, all right, this is from oil and gas executives themselves. Not from, not from Republicans, not from Democrats, like whatever. Which of the following is the primary reason that publicly traded oil producers are restraining growth despite high oil prices? So this question is basically, why are you not increasing drilling even though oil prices are high? 10% said government regulations. 10%. These are executives in the oil and gas industry, by the way. So these are people at Chevron, at ExxonMobil, at all these places. The majority of respondents said investor pressure to maintain capital discipline. So hear me out real quick. If you're freaking Exxon or you're freaking Chevron and you're drilling, let's say 100 barrels of oil a day, and you're making a killing off of it because gas prices are as high as they've been, whatever, your profit margins are great. Investors are happy. You're buying back the stock. You just set out a record quarter. Why in the hell would you want to spend money now? Would you want to spend some of that money that's going back to shareholders, that's getting kicked back to investors, to start drilling now for growth down the road, when down the road gas prices might fall, and then you drill now to start drilling for gas that's not worth what it was when you started building that to drill? You got a good thing going. Keep the good thing going. Investors are saying, no, don't start to try to grow right now. Just keep kicking us back that money. So if that's what your problem is, that that these big companies aren't drilling or aren't growing more, the reason why is because they're shareholders, because they're investors, not because of Biden or not because of Trump, not because of Republicans or not because of Democrats, but it's because about the money. Yes, Sydney, it costs a lot of money to start doing new drilling. No drilling, right? All right. You're right. You're right, Bruno. It's not because the companies want to make money. It's because big bad Biden, because bad Joe Brandon doesn't want the U.S. American oils companies drilling. That's why he's putting more permits out there than. You're right. You're right, Bruno. Oh yeah, I've been on my rant. I didn't even realize it's almost freaking 15 minutes past 1. Sorry guys. Sorry to Money Mitch primarily, but let's get this wrapped up. We've got learn, Grasshopper, learn. I'm trying to learn. I try to learn every day, but Bruno, sorry bro, from what it seems like, it ain't gonna be from you. But guys, thanks for hanging out with us today. Thanks for staying on through some of these rants. I know got a little heated, maybe a little too political today than what most people would like, but I don't know. I mean, Powell's coming up, 45 minutes. We're gonna get the 45. We're gonna get the press conference, or we're gonna get the release of the actual numbers, and at 2:30 we're gonna get the press conference. Again, I gave my prediction. I think we're gonna see the big move at 2:30 p.m. ET. My expectation is for that move at 2:30 to be to the downside, because I think Powell is going to stay hawkish, basically say, hey, look, inflation is still, more than double the rate we're going for. And we've got no reason to start cutting right now because shit's pretty strong out there. It's not like we're seeing unemployment rise or anything. So that's my prediction today. Again, not investment advice. We'll be back tomorrow, 11:30 a.m. Eastern. Thank you again. Smash the like. And sorry again to Mitch. Thank you for being patient with me today. Make sure be more timely and prompt with that ending tomorrow. Before I wrap up, Mitch, I'm just gonna double check and make sure that the redirect is set, and then we should be good to go. I also think, by the way, yeah, we're good. Also, you know what, never mind. Mitch, all you, man. We'll be back tomorrow. Peace and love.